Ever since this pandemic hit, our housing market has been booming because the Federal Reserve Bank slashed interest rates, which made it cheaper for you to go out and buy a home because now mortgage rates were so much lower. Now, this was kind of a strange situation to see because the United States entered a recession, and at the same time we entered a recession, we also entered one of the biggest housing market booms that we have ever seen in history. And so we have our economy that's struggling, but we have some people that have the cash to buy a home, and this is causing home prices to go like this while the economy is on real choppy waters. Now, to make matters a little bit more crazy, we have some new proposals out right now which could take a housing market to new insane levels. And so you got to understand what's going on. Between 2020 and 2021, we saw the median wages in the United States grow by right around 3%. At the same time, we saw housing prices between March 2020 when the pandemic hit and March 2021 grow not by 3% but by 15.6% in just 12 months. And I'm talking about the median home prices in America here. Generally, you want to see home prices grow at the same rate as wages, because if home prices are growing like this while wages are only growing like this, eventually you are going to hit a tipping point. Eventually you're going to hit a point where buyers can no longer afford homes. Because if housing prices keep going up like this, eventually, right, you're going to hit a point where your income is not going to afford new home prices, and so buyers are not going to be able to buy homes, and this would cause a housing market correction, because if people can't afford homes, then home prices have to correct, not crash, but correct so people can afford homes, and then this would eventually hopefully cause the housing market to go back up. But a few things that have been fueling this housing price growth between 2020 and into 2021 has been low interest rates, because in March 2020 we entered this recession and pandemic, and so the Federal Reserve Bank slashed interest rates, which made mortgage rates drop, and so everybody was trying to buy a home and take advantage of these low interest rates. And second, we had a super low inventory of homes available for sale. So you had all these people that wanted to buy a home and not that many people selling homes, and so everybody who wanted to buy a home went out and they were fighting each other to buy a home. At the same time, we had this mortgage forbearance program created because now you had a lot of people that didn't have money to make their mortgage payments. Typically what would happen, we saw this happen in 2007 and 2008 and 2009, if you cannot make your mortgage payments, the bank is going to come in and they're going to take your property away from you. They're going to foreclose on you. But the government stopped that from happening. And so now you had a lot of people that weren't selling their homes. So you had a low supply of homes available for sale, and you had a lot of people that can't afford their housing payments, but they're not getting foreclosed on because of the forbearance program. This brings me to the issue that we're facing right now, forbearance. So back in 2020, the government created the CARES Act, which allowed people who had a government-backed mortgage to put their mortgage on hold through the forbearance program. Essentially, whether you're facing a financial hardship or not, you could put your mortgage on hold for up to 18 months. They kept extending it, but up to 18 months, which means that the mortgage forbearance program, assuming that you entered into it when it first started, you would be ending in around September, October of 2021. But the CFPB, or Consumer Financial Protection Bureau, has put out a brand new proposal that will do three things to help out the 2.6 million Americans that are in forbearance right now. The first thing they want to do is they want to give borrowers more time to come up with a plan on how they can recover on their finances after the forbearance program ends. And so what they're proposing is no foreclosures until 2022. Essentially, they're saying that you cannot file a foreclosure on somebody until after December 31st, 2021, which means you will not be able to foreclose on anybody until 2022. But this rule only applies to primary residences, which means if you have an investment property, this does not apply to you. The second thing they want to do is give you more options. That way you have more ways to kind of get out of your forbearance program without real financial hardships. And so they don't want people to end their forbearance program and they get slapped with late fees or fines or huge lump sum payments. And so one of the options is actually going to really shake up the housing market, because one of the things that they're proposing is to give borrowers who are facing a hardship because of this pandemic to now extend their mortgage to a brand new 40-year mortgage. And the third thing that this proposal talks about is that banks will have to keep you up to date as a borrower as to what your options are. So even if you weren't aware that you could take this new mortgage of 40 years, the bank is supposed to tell you that if you are facing a financial hardship. So if this gets passed, banks might be required to ask you if you faced a financial hardship because of this pandemic, and if so, then banks might have to give you different options on how you can pay back your mortgage. The third thing that I want to talk about is equity, because when home prices are going up, this is very good for homeowners, but it's not so good for people who want to be homeowners, because now if you are a homeowner and home prices keep going up, you just found brand new wealth because now you have more equity, at least on paper. If you really want to understand the housing market, you have to pay attention to equity and how much equity people have in their homes, because one of the reasons why the 2008 crash happened was because people had no equity in their homes. There are two big reasons for why somebody would want to refinance their home. One is if interest rates fall and now you can save money on your mortgage. And second is if home prices go up and somebody wants to pull out some cash from their home. A lot of people like to compare 2021 and 2020 to 2008 because they say, okay, in 2008, you had 3 million people that were not able to pay their mortgages that received a foreclosure notice. In 2021, right now, like I talked about, you have 2.6 million people that are not able to pay their mortgages. Now, there's a big difference between what happened in 2008 and what's going on in 2021. Back in 2008, you had a lot of things building up because back before the 2008 crash, people were not able to afford homes. That's similar to what you're seeing now. But what happened was banks started creating these new programs such as ninja loans, no income, no job, no asset loans, letting people who have no money buy a home. You could buy a home with little to no down payment at all. And then on top of that, because you couldn't afford the home, you had these low variable interest rates, and these variable interest rates came in with these very low teaser rates. And so right now, we still have a lot of people that are struggling to be able to afford a home, kind of like what you saw happen in the mid-2000s. Now, the way the banks and our systems are working to help people buy homes is very different than before, because now we don't have those ninja loans. We don't have a lot of people getting variable interest rates, thankfully. They are starting to come back, but we don't have a lot of people getting variable interest rates. And so people are buying homes with fixed rate mortgages. The second major difference between now and then is now you can't even foreclose on somebody who is not able to pay their mortgages. Back then, if somebody wasn't paying their mortgage 120 days later, they were in the process of getting kicked out of their home. Now, it's not allowed by the government. And so even if this forbearance program ended and people were still not paying their mortgages, you still wouldn't see these foreclosures because the government is not letting that happen. Third, the government is trying to do what they can to make housing more affordable. Now, what's interesting is these programs will actually end up making housing less affordable in the future, but we'll talk about that in just a little bit, because now the government is saying that they're working to pass a $15,000 first-time home buyer credit to people who want to buy their first home. So this $15,000 credit would essentially be free money to people who want to buy their first home, and this money could be applied to your down payment. What's coming next? Well, over the long term, home prices cannot sustainably grow many times faster than wages. It's just not sustainable. And so you have to kind of pay attention to, one, how fast home prices are growing, and second, how fast wages are growing. But home prices can go up fast as long as you have this kind of influx of buyers with not enough sellers in the market. And so yes, although home prices are growing way faster than wages, this can keep happening as long as you have way more buyers than sellers out there. And there's a few different things that can fuel that. One is low mortgage rates. So if you continue to see low interest rates, that will continue to bring more buyers into the market because people will want to take advantage of this cheap debt. Second is a low inventory of homes available for sale. So right now, we still have a labor shortage and a material shortage, which is making it harder for people to develop and build new homes. And so if it's taking longer for people to build new homes, then that could keep the inventory of homes available for sale small. But if we see a whole lot more homes getting finished and being sold and being developed, then that could increase the supply of homes available for sale, which could help kind of balance this market. And so if we have a whole lot more homes available for sale, then that could balance out the buyers, which would slow down the housing price growth. And the third thing is the economy, because right now what we've been seeing happen is a K-shaped recovery. What that means is we had some people that were really impacted in a good way by this pandemic, and these are the people that have been buying homes. These are the people that came out of the pandemic stronger or were not hurt by this pandemic, and so they still had an income. They were able to qualify for a mortgage. They were able to take advantage of this cheap debt, and they were able to go out and buy homes. But at the same time, we had a lot of people that were hurt by this pandemic, that are not able to qualify for a mortgage right now because they lost a job, or they lost an income stream, or they saw their wages get cut. And so for the people that are working in the retail sector, or the hospitality sector, or the food restaurant sector, these people were hurt by the pandemic. And these are people that are not able to buy homes. And so if the economy starts to recover very quickly, and you see these people get their jobs back, then what you're going to see happen is a lot of these people may want to now try to take advantage of these low interest rates, because although mortgage rates are not where they were a little while ago, they're still historically low. And so if we start to see these people start to buy homes, this is a whole new wave of people that are going to want to go out and buy homes. And so we could see, if the economy recovers, a new wave of buyers enter the market, which would continue to push housing prices up, at least in the short term. So in the short term, the next 12 months, maybe 18 months, we could continue seeing the housing market boom at record levels, assuming interest rates stay low, assuming that we have a low supply of homes available for sale, and assuming that the economy continues to grow. If these three things happen, you can see the economy boom, especially in the short term. Now, over the long term, we have a lot of fundamental issues, like I talked about. We have a lot of cheap debt. We have a very high national debt. We have inflation that is growing. We have a higher cost of living. And if people are not able to afford their livelihood, if they're not able to afford a new home, if they're not able to afford their housing payments, now we could continue to see major issues in the future, which could cause a correction, maybe in the crash. Now, when is that going to happen? I have no idea. But in the short term, our housing market looks like it's set up to boom, at least based on the information that we have right now.